The modern banking institution in India started with the establishment of General Bank of India in 1786. In the mid-19th century, the East India Company established the Bank of Bengal in 1809, the Bank of Bombay in 1840 and the Bank of Madras in 1843. These were initially independent units and were referred to as the presidency banks. Subsequently, these three banks were amalgamated and became known as the Imperial Bank of India. After independence, the Imperial Bank of India was nationalized under the State Bank of India Act of 1955 and became known as the State Bank of India. Nationalization was a major change during the period after independence due to the socialist philosophy adopted by the first Prime Minister Jawaharlal Nehru. In 1969, his daughter Indira Gandhi, then Premier, continued this process by nationalizing 14 major banks. Indian banks are unique in many respects. Prior to 1991, all banks were state-owned. In 1991, when the government opened banking to private banks, example ICICI Bank and Bank of America, the public sector has dropped by 20%. However, the state-owned banks still controls approximately 80% of the country's banking assets. The Indian government has a tradition of using state-owned banks to rescue failing institutions or to funnel money to favored projects which has little chance of paying off the loan. Further, a study by MC Kinsey and Co. consultants finds that the productivity of Indian banks are only 1/10 on the productivity of US banks. In general, India's banking system is so dysfunctional that it is slowing the economy.